Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 2nd, 2026. Hey, how you doing? Thanks for coming to my podcast today. I hope you're going to find it helpful. I hope that you had a good trading week, and I hope you're having a good weekend as well. So, the format for today's podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I currently entered and exited. Was a good week, and so grateful for that. But we're going to talk about when I entered the trade, why I entered the trade, what were the signals, what were the confluence of signals of how I entered and why I entered the trade. We're going to talk about how I position size to enter the trade, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market starts to move in my direction, how I go into trailing stop level, and then ultimately how I completely exit the trade. I think I have some good examples today of stocks that I'm currently managing and about to get out of and still staying in. So we're basically going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trades going forward. After that, we're going to talk a little bit about trader psychology. It's always the most important skill in trading. I'm a 100% believer in this, is creating a plan and then more importantly, following the plan. There's a lot of trading plans. There's a lot of trading strategies, processes out there, a lot of really good ones. But if you don't follow them, they're worthless. And when it comes to trading, whatever the plan is, it should give you the ability, if you're wrong, to be wrong small, and if you're right, to have the potential to be right big, or anywhere in between. Large gains, of course, are great. Small gains are great. Break-even trades, fine. Small losses, fine, but we have to stay away from the large losses. That's really the key. And having the correct trading plan to do that is really important. You need to have a structure of the plan so you just know when you are wrong, and hopefully you can be wrong small. But it all comes back to trading psychology, all comes back to being able to follow your plan. So I always like to talk about trading psychology. It's always helpful for me to teach, and I hope it is helpful for you as well. After that, I went down through my master watch list last night, and I have identified some potential nice looking setups for the coming week. Now, they're not where they need to be yet, and if they were, I probably would have already taken them, but they're getting close to confluences of signals. They're getting close to levels, multiple levels, where I'll wait and look next week to see if these levels are rejected. And then if they are, I can potentially put the trade on. And if I put the trade on, again, the structure will be that I'll have the format of the trade that it gives me the ability to have large outsized gain if I'm right, and smaller losses if I'm wrong. And that's, as traders, that's really all we can hope for, is being patient, looking for the trade, structuring it so we have potential to have a large outside gain and small loss if we're wrong. All right, so I hope this is going to be helpful for you today. If you have any comments or questions along the way, please put them in the comment section. I'll do my best to get back to you and to answer your questions. And if you do find it helpful today, I really would appreciate it if you could just take a moment and hit the thumbs up button or subscribe to the channel. That would be great. Helps the channel out a lot, and lets YouTube know that there's some valuable content here so they can get out and share it more to other traders. So thanks for that. And let's first of all run this US legal disclaimer, get this out of the way, and then we'll come back and we'll get started.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. AMD, this has been one of the largest trades I've had in years. And maybe when this is all said and done, it will be my largest. I had a 50% gain on natural gas years ago, on the monthly charts, by the way. But this one is definitely closing in. So I bought AMD back here on the 30th of March at 196.10. Unbelievable. Look at this trade. But, the reason I took this trade was based upon two things. It was based upon a rejection of the 200-day moving average, which is the black line. Then this moving average resides inside an order block. These are my favorite setups. So you can see the black line. During the day, we went below the black line and we closed back above it. So that's pretty simple. But the key is the black line, 200-day moving average, resided in this order block. So let's go back, and this order block was formed in the past. Let's go back in the past and see what an order block is and why and how it was formed and why I use that as one of my entry signals. So an order block, um, uh, the pattern for the order block is as follows. First of all, we need to start off with a swing low. A swing low is simply a low point that has a higher low to the left and then a higher low to the right. So this qualifies, right? The bar to the left has a low that's higher than this low. The bar to the right has a low that's higher than this low. So we have a swing low. Now, after you find the swing low, it needs to be followed by a swing high. And the swing high is just the opposite. It is has a lower high to the left and a lower high to the right. So we have that swing low, swing high. Now, the next thing we need is another swing low, just like the first swing low, but that's lower than the first swing low. So here's the second swing low. Higher low to the left, higher low to the right. But this swing low was lower than this swing low. So that's the key. You need to run the liquidity of the first swing low. So we need a swing low, followed by a swing high, followed by another swing low that's lower than the first swing low. Okay, check, check, and check. Now, the key is when you have this in place, we need to refer back to the first swing high. And in the future, if you have the swing low, swing high, lower swing low, then if the market moves up above that first swing high, that is when we have what is called a bullish market structure. We have changed market structure to the upside. And as soon as this happens, swing low, swing high, lower swing low, market structure change, now we can identify our order block. And our order block is the lowest closing bar prior to market structure change. And that's this. The high and the low of this is the order block. After we change market structure, the high and the low of this bar is the market structure. Now, as soon as we change market structure, the idea after we change to a bullish market structure is to buy dips. You've probably heard the saying, buy dips in an uptrend. Well, when you change market structure to the upside, the way that I view trading is that you have now changed market structure to the upside and you are in an uptrend. Therefore, I want to buy dips. So where do I buy dips? I buy dips when it comes back into the order block that we just defined. Remember, after it changes market structure, lowest closing bar prior to market structure, that's the key point. So the high and the low, I bring this all the way into the future, and that, if it has a pullback into this order block, that's where I'm looking to buy. So look here. The order block was formed here on 11/25/25. Okay. Now let's look in the future. When we're all the way up here at 264 and we look back here to the order block, can we confidently say that smart money was buying here when ultimately it went all the way up to here? I think the answer is yes, 100%. People that were buying here, that clearly, in hindsight, was smart money when the price is up here. So this order block, another way to look at it is a smart money area. And so in the future, if the price comes back to the order block, I want to be looking, and there's different ways to enter into the order block, and I'll share those with you. But you can see right off of the bat, as soon as we change market structure here, came back to the order block, that's where it took off again. Came back to the order block, took off again. So I'm going to bring this order block all the way into the future, and here it is now. If AMD comes back down to here, I'd be looking to buy again, clearly, right? But this is where I entered here on the 30th of March at 196.10. Why? For one, it was inside the order block, and two, we had the 200-day moving average that I used as my line in the sand. Now, the 200-day moving average is a key moving average. A rejection of the 200-day moving average is a valid entry anyway. Close under the 200, close over, intraday rejection, bounce. They're all valid areas. They're all valid rejections. But again, the key with this particular trade was there was a rejection of the 200-day moving average inside the order block. So, okay, so this is why I entered. Again, I entered at 196.10. So when I enter the trade, obviously the first thing I have to decide is, well, how many shares am I going to buy? If I'm going to get long AMD, how many shares am I going to buy? And I use a very simple formula that has worked very well for me in my 30 years of trading. And the first, I need two pieces of information. The first piece of information is, how much do I have in my trading account? Let's just say I have $200,000 in my trading account. It works for any amount. I just take 1% of that. Very simple. A lot of people do this. I just take 1% of however much I have in my trading account. So if I have $200,000, 1% of $200,000 is $2,000. So that's the first number I need. This is the maximum allowed loss I will have on this trade. If I'm really, really wrong, this is how much I will lose. I would lose 1% of my account. Now, 1% of $200,000 is $2,000. The next thing I need to look for, what is the value of the 2ATR? Basically, the 2ATR just shows you the volatility of the market. If the market volatility is higher, this number is higher. If it's lower, this number is lower. So I take 1% of my total capital, 1% of $200,000, which is 2,000, divided by whatever the value of the 2ATR is on that particular day that I'm entering, divided by 21.56. That shows me how many shares to buy. 92.7. So I'll just round that up to 93 shares. All right. So I enter here the rejection of the 200-day moving average inside the order block, and I buy 93 shares. Okay. The first thing I do after I enter, I look back to this number, 2156, and I subtract that to my entry price. So if my entry price is 196.10, I subtract 2156 from that, and this is where I place my emergency stop. After I enter here, if I have 93 shares and they move down 21.56 to my end of bar stop, how much have I lost? I've lost $2,000. I've lost 1% of my account, right? That is the number where I said, no matter what it is, how bullish I am on this stock or this trade, if it gets there, clearly I'm wrong. And that's what I'm going to lose, 1% on my account. Not fun to lose 1% of your account, but you can recover from that. But the good news here is that hitting this emergency stop, losing the 1%, only happens about 5% of the time. The other 95% of the time, if I have a loss, it is not going to be because it hit my emergency stop. That's there for worst case scenario. The other 95% of the time, if I have a loss, it will be because of my end of bar stop. And so I always have two stops. I have an emergency stop, which we just talked about, and I have an end of bar stop. An end of bar stop is simply a close on this particular trade. I know it's a little hard to see because the market's run up here so far that it scrunched the view of the charts. Apologize for that. But my end of bar stop is just simply a close below the 200-day moving average. That's why I took the trade in the first place. I took the trade because it rejected the 200-day moving average inside the order block, closed above it, So I position size, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 200-day moving average. That's it. That is it. And so if the next day it had closed below the 200-day moving average, I simply would have gotten out for a small loss, not a 1% loss, right? Because 1% loss would be if it got all the way back down to my end of bar or my emergency stop. But thankfully, it didn't do that, and it kept moving up. So once I see the signal, decide how many shares I'm going to trade, place my emergency stop. I know where my end of bar stop. The next thing that I want to do is I want to look to the value of the 1.5 ATR. The value of the 1.5 ATR is $16.17. $16.17. So what I do at this point, I take my entry price and add the 1.5 value to it above. And that is where I place my orange line. This is my trailing stop level. If I buy and it gets to my trailing stop level, doesn't mean I necessarily do anything at that moment. It just means that now I'm in trailing stop mode, or in other words, once I get to trailing stop level, if then in the future I have a close below a previous bar's low, I'm going to exit half. And in trading, if you enter a trade and it starts moving nicely your way, at some point you want to tighten up your stops. You don't want to give it all back. So this is the way that I do it. I don't actually move my stops up, but I take half of my position off, which ultimately has the same effect. If I sell half my shares, it moves everything up. All right. So anyway, I hope that makes sense. Rejection of the 200-day moving average inside the order block. I position size, I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below this black line. I put my trailing stop level above. You can see 2 days later, I go into trailing stop mode. All right. So everything I've talked about so far, as far as the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves. So in other words, if the market goes against me in any fashion, I have to take action. That's defensive. But I also like to play offense in my trading as well. And the way that I do that is I take a portion of my position off each day if it moves a certain amount from the previous bar's close. And that's the offensive part. So it's so far up here, but let's take a look at how I'll show you exactly how I'm going to do that for this coming Monday. So it's very simple. All I do is I take the closing price of each day. Right now, the closing price is $360.54. Okay. Now I look over to the 0.45 ATR value, which right now is 683. So I take my closing price, 360.54, plus the value of the 0.45 on this day, and right now it's plus 6.83. My first profit target for Monday is 367.37. 367. There's my first profit target for Monday. Now, I place 3 profit targets, but starting with this first profit target, how much would I take off there? 10% of however many shares I go into the day with. If I go into the day with 50 shares, 10% is 5, and I would take off 5 at that level. But again, I place 3 profit targets. So the first profit target is simply the closing price plus the value of the 0.45 ATR. 360 plus 683 is 367.37. But now I place another profit target. All I do is take the first profit target, 367.37, and add the 0.45 to it again, plus 6.83. My second profit target for Monday is 374.20. Okay, there you go. And I'm going to do it one more time. I take the second profit target, 374.20, plus the value of the 0.45 ATRs, My third profit target for Monday is 381.03. There you go. So those are my three profit targets. Now, if it goes down on Monday, I'm not going to hit any of them. But if it goes up and I hit one, great. It has a lot of benefits. I'm locking in profits on strength. I'm reducing my overall position size, which is important because as you have fewer and fewer shares, you're much more likely to follow your process exactly because there's less heat, there's less stress as your position size gets smaller, and it taking partial profits on the way up just has the effect of moving all of your stops up every single day, which is great. Now, Monday, if it comes down, okay, I I didn't hit any of my profit targets, and then at the end of Monday, I'll have to rewrite for Tuesday. And if the market's lower on Monday, then the profit targets that I'm going to write are not going to be as high as they were here because now we're down. So it's always the closing price plus the value of the 0.45 ATR three times. And so I three profit targets every day. And what I do is I just put a limit order in the system. If I have 50 shares, I'm going to sell 5, 5, and 5, and that's it. That's it. It happens during the day. So I think it's important to play offense and defense every single day. So, okay. So now this is kind of the basics of the trade. Let's just kind of start one more time. And entered here 330.26, rejection of the 200-day moving average inside the order block. I entered at 196.10. I position size by taking 1% of my capital divided by the 2 ATR. That gave me my emergency stop. That 2 ATRs below. If it gets there, I'm going to lose 1% of my account. Again, it only happens about 5% of the time. My end of bar stop is simply a close below the 200-day moving average. As soon as I do that, I place my trailing stop level 1.5 ATRs above. This is the orange line. Again, sorry, the configuration of this chart, because it's moved so hard up, it's hard to see things clearly. So I apologize for that. So anyway, I placed the trailing stop level up here at 210.50. Next day, opened up down, closed above the 200, kept me in the trade. Next day, moved up nicely where I took some profit targets. Also got to trailing stop level. It moved to 1.5 ATRs above my entry. Now, I don't do anything with this here. It's just now I'm in trailing stop mode, which just means in the future, if I have a close below previous bar's low, I'm going to exit half. Next day was up, took some partial profits there. Next day, up again, partial profits. Next day, nothing. Next day, partial profits. Next day, nothing. Next day, partial profits. Here, partial profits. Here, multiple profit targets into that strength. Then a couple days of sideways motion. Have you noticed we have not had a close below previous bar's low, so I didn't have to do anything. Profit target here, multiple profit targets here, one profit target here, multiple. I can't remember how many profit targets I took on this day. I think it could have been 7. Unbelievable. Then here, I had to take some action. This was the first time we closed below a previous bar's low after getting to trailing stop level. What did I do? I took off half of my position. All right. And I locked in a gain of 41.34%. Unbelievable. Now, at this point, we're extremely overbought. We're over the 65 RSI level. So if we're over the 65 RSI level right now, you can see we're at 79.84. In the future now, if I have a close below the 5 EMA, which is this thin blue line, I will be completely out of the trade. And then the very next day, it opened under the 5 EMA, and I thought, oh, this is the day to exit the trade. Yet it recovered, closed above, kept me in the trade. Next day, up again, profit targets. Next day, up again, profit targets. And then I hit another profit target here on Friday. So this trade at this point is extremely easy. I've already taken half off for 41.34%. If it continues to move up, I'll continue to take partial profits as I just showed you. Those are my 3 profit targets for Monday. However, if it closes below the 5 EMA, that's it. I'm completely out of the trade. But I won't be in this trade very much longer because we have earnings coming up here on the 5th of May, and I never hold through earnings. So one way or the other, I will be out of this trade next week. It just depends uh, uh, what happens with the price of the stock before earnings. But at the moment, the remaining shares I have on AMD 45.45. Unbelievable. These trades don't come along very often. Maybe once every few years, but it's nice to have them. But the key here really, if we look at this big picture is, and this is the perfect example. I took this trade here. If I was wrong, I very likely would have been wrong, very small. So I risked a small amount to make a huge amount. All the profits that I've made on this trade, I can rotate back into other trades, right? A 45% gain, that pays for a lot of little 1%, 0.5%, 1.5% trades that don't work, right? So perfect example of good risk to reward, being patient, and having the potential for large outside gain, which of course this one was. All right, let's go to silver. SLV. Okay, this is a little bit different type of trade. I just got done telling you about taking partial profits and going into trailing stop mode and everything. And all the trades that I enter, the majority of trades that I enter, this is the process that I use. But there is one type of trade where I don't go into trailing stop mode. I don't take partial profits. It's a very easy type of trade that when I enter, I place a 2 ATR stop if I'm wrong, in which case I lose 1% of my account, and I place a 4 ATR profit target if I'm right, in which case I make 2%. So I'm risking 1 to make 2, and this is silver. So silver is a combination of two signals. I have an order block from the past, right? So a smart money area. And with an order block, there's multiple different ways to use these to get in and out. You can get in, like I showed you on AMD, with the rejection of a moving average inside the order block. That's one way. You can get in with the rejection of the bottom of the order block. That's another way. You can get in with the rejection of the top of the order block, which is another way. And this is partly why I entered this trade. So I entered silver here on the 18th of February at 69.80. So let's look at the order block first. This is a rejection of the high of the order block. The order block is the green box. The previous day we closed in the order block. The next day we closed above the order block. This is what I mean by a rejection of the high of the order block. So was it a rejection of the high of the order block? 100%. We closed in, we closed above. That's one aspect of why I entered. The other aspect of why I entered is what's called an abandoned baby. And you can see this bar here in blue that I've highlighted. So what's an abandoned baby? Abandoned baby is a bullish signal. I really like abandoned babies, but they consist of 3 bars. Bar 1, bar 2, and bar 3. And what happens is you have bar 1, and then bar 2 gaps down. You can see from bar 1 to bar 2, bar 2 gap down from bar 1. So from the close to the open, there was bearish sentiment, very bearish sentiment. It gapped down. However, you can see the next day, the third day, we gapped up. And I can tell you from experience that when you gap down and then you gap up, more times than not in the future, you're going to be higher. There's a lot going on under the hood when the market is extremely biased one way and then immediately goes the other way. All right. So you can see this is the abandoned baby. It's called an abandoned baby because it's kind of left down here kind of by itself, abandoned baby. So the combination of this trade was a rejection of the high of the order block and the abandoned baby. So generally when I use abandoned babies and I enter the trade, like I just mentioned, I give myself a 2 ATR stop loss and a 4 ATR profit target. So I entered here 69.80. I position sized 1% of my capital divided by the 2 ATR. I place my emergency stop down here. If I get down here, I lose 1% of my account. Now, to the upside, I take my entry price and I add 4 ATRs, twice as many ATRs to the upside as what I'm risking to the downside. But it's very simple. I just put the trade on. In the future, for sure, either it's going to get here at some point at my emergency stop, or it's going to move up to my profit target, which is 4 ATRs. So, Bannon baby, rejection of the high of the order block, position size, 2 ATR stop, 4 ATR profit target, and I'm just going to let this trade run until one of those two things happens. And so you can see, once I entered, it started off really, really, really great. Didn't get to my 4 ATR profit target, so I don't do anything. And then, so it moved up, and then it came down. It came down, but again, it didn't get to my 2 ATR stop, so I didn't do anything. We moved sideways, we moved up, then we moved down, and then we've started to have a little bit move up. Actually, at one point on Friday, it got right to my entry point. But currently, this particular trade is down a little. It's down 2.25%. But again, it's a one or the other trade. At some point in the future, I'm either going to hit the 4 ATR profit target, 2 ATR profit target, or I'm going to hit the 4 ATR profit target. One of the two is going to happen for sure. And I liked my entry point. Can you get into a trade and always put a 2 ATR stop and a 4 ATR profit target? You can, right? But the edge comes from entering at the correct location with the right signal, and that's what I did here with rejection higher the order block and the Abandon baby. So we will see. But this one is currently down 2.25%. DIA, which is the Dow Jones. Now, you've heard me talk about order blocks, bullish order blocks, green. Look down here. Did that order block call the bottom of the market? It certainly did. It rejected the bottom of the order block and closed back in it. There's your entry signal using an order block. Was it correct? 100%. But we do have bullish order blocks, but we also have bearish order blocks. Bearish order blocks are just the opposite. Instead of having a swing low and then a swing high and then a lower swing low and a market structure change, you have a swing high followed by a swing low followed by a higher swing high followed by a market structure change to the downside. So I did enter DIA as a short on the 17th of April at 494.27 because it rejected the 70 RSI inside the bearish order block. So I positioned size like I normally do. I placed my emergency stop 2 ATRs above. My end of bar stop is a close above the 70 RSI because that is why I took the trade, or a close above the high of the order block. I placed my 1.5 ATR trailing stop level below, and here we go. The next day, didn't do much. The next day gapped up, went against me. I thought, well, I'm going to be right out of this trade. But by the end of the day, it closed down. It kept me in the trade, and I hit a profit target. The next day, it gapped up again, but it didn't close above the 70 RSI. The next day, at the low of the day, I took another profit target while it was down there. Then we kind of moved sideways for a few days. Wednesday, it did move down, so I took a profit target into the strength on the downside. Thursday, of course, we had the big rally up, but it did not close above the high of the order block, kept me in the trade. Friday, yesterday, it gapped up, but it closed back in the order block, kept me in the trade. So I am slightly down on this trade. Not much, 0.13%. But going forward, if it continues down, I will continue to take profits. If it closes above the high of the order block, I'll simply get out of the trade. So not a lot going on here with DIA, but I am short. and I'll stay short until it either closes above the high of the order block. That's it. UNG. All right, UNG is another trade where I have a 2 ATR profit target and a 2 ATR stop and a 4 ATR profit target. This trade goes, the reason I entered, well, I entered here on the 15th of April at $10.57. But the reason that I entered in today's podcast, I have a lot of kind of these setups that are kind of unorthodox from that don't generally happen, but they're happening. So I took the trade. So I took the trade here on the 15th of April at 10:57, and the reason I took it goes back to these three bars here. So I talked to you about abandoned baby, where you gap down and then the very next day you gap up. So if you have one bar, it's abandoned baby. If you have multiple bars, you have more than one bar, it's called an island reversal. And this is an island reversal. So an island reversal happens when you gap down and then you have more than one bar going sideways, and then you have a gap up. So as soon as this day happened here on the 20th, we made the island reversal. Gap down, sideways movement, gapped up. So you see how these three bars here were kind of left by themselves? That's what creates the island reversal. Now, when you create a abandoned baby or you create a island reversal, once that creation happens, the high of the baby or the high of the island reversal, there's going to be some inherent support there. So I noticed the abandoned baby here. I know that the high of this island reversal is going to be a key support level. So I bring that key support level into the future. And so you can see, was abandoned baby right? Well, yeah, ultimately for a week, it was really right because it just moved up. But now, of course, UNG, natural gas, has to move back down. And then that's why I entered the trade here on the 15th of April, because on this particular day, it rejected the high of that island reversal in the past. And when I use abandoned babies, or if I use island reversals, I go to the 2 ATR stop, 4 ATR profit target. So I entered here 1057. I position sized. I placed my emergency stop 2 ATRs below. I placed my profit target 4 ATRs above. And I just set it and forget it. I'm either going to lose 1% or I'm going to make 2%. And I know from experience, more times than not, I'm going to make 2% instead of lose 1%. And so when I entered, started off great, immediately started up, moved up. Now we moved down. We've had a little bit of back and forth, but at the moment, currently, because Friday was up on the trade, not a lot, up 1.58% on the trade. But again, not taking partial profits, not going into trailing stop mode. It's one or the other. I'd lose 1% of my account or make 2% of my account. LMT. All right. LMT is a trade that's really kind of my favorite trades, where you have major moving averages, 200, 250, 300-day moving average. These are deep dip buy moving averages. When I teach deep dip buys, they have to do with the 200, the 250, the 300, or the under 30 over 30. But as I mentioned to you early in the podcast, when you have a deep dip buy entry signal within an order block, it just makes them a lot stronger. So I entered LMT here on the 27th at 513.36. Why here? Well, it had to do with the day before. You see, the day before we rejected the 250 and then closed above it. So I didn't take the trade on this day because I took another trade, but it would have been a legitimate entry on this day as well because it rejected the 250 inside the order block. So the next day was pretty much the same as the previous day. So I just took the trade here. So I entered 513.36. I position size. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. and my end of bar stop is simply a close below this 250. That's it. So if I'm wrong, I had the potential to be wrong small. So the next day it was down a little. Next day it was down a little. It did retest the 250 on this day. You see how during the day we went below it, but we closed back above it. And then the next day we moved up, where I did take a profit target, and then we were down a little here on Friday. So it's moved sideways since I've taken the trade. It hasn't done anything, but the key thing is that I know exactly what I'm going to do. If it moves up, I'm going to take partial profits. It gets to my trailing stop level, I'm going to go into trailing stop mode. Monday, excuse me, if it closes below the purple line, if it closes below the 250, I'll simply be out. That's my line in the sand, and then I have my emergency stop down here, 2 ATRs below, in my worst case scenario. So if then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. So this particular trade is essentially exactly break even. Well, I shouldn't say exactly. 1536, that's it. I'm sorry, 51336, that's it. 51277. So it is down just a touch, just a little bit, probably about 0.22%. So anyway, going forward, if it closes below the 250, I'll simply be out. That will be the end of the trade. I can always get back in. Netflix. All right, I took Netflix here on the 28th of April at 92.18. Why? Well, again, it had to do with the moving average inside the order block. Here's the order block from the past, the smart money area from the past. We're back in the smart money area. And I took this on the 28th because we rejected the 100-day moving average, which is the red line, during the day. During the day, we were below it. We closed back above it. I entered at 92.18. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the red line. That's it. In addition to the rejection of the 100 on the day that I took the trade, we also have a V1. V1's a great entry signal, adds value to the trade. V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, then closes above bar 1's close, right? That just adds bonus points to the signal. And if you want to learn more about V1s, V2s, just go to my YouTube channel. I have videos there on them that describe them in detail. And then I place my 1.5 ATR trailing stop level above. The next day, basically closed unchanged. Thursday, we had a nice move up where I was able to sell some partial profits into that move. Friday, we opened higher but closed lower. But am I still in the trade? I am. Essentially break even on the trade, maybe down just, let's see, yeah, down about 0.17% on the trade because of the reversal on Friday. But I'm still in the trade until we close under that red line. If we close under the red line, I simply get out. If we continue up, I take partial profits as it moves up. I have no control of any of this. Nobody does. So I just have my rules and I follow my rules, and it just makes trading easy. All right, love. All right, good example on love. And I'll show you, I've entered this trade twice. The first trade that I entered was here on 4/23/26. Why? Because we have a rejection of the 200-day moving average. That's the black line. We have a rejection of the 200 that happens inside the order block. You see that? The next day, started off great, moved up, took profits into that move. Then the next day reversed back down. The next day was down a little, but it kept me in the trade because I closed above the 200. But then here on Wednesday, I had to get out of the trade. Why? Because it closed below the 200-day moving average. And on this particular day, I had to lock in a loss of 1.43%. But this is, you know, I always tell my students this. If you close below your stop, just great, get out. Doesn't mean you can't get back into the trade. You can get back into the trade if it closes back above the 200, which it did on Thursday. So I re-entered the trade here at 37.75. So you can see I took a small loss on the trade because it closed under my stop. But in the future, if it closes back over, you can try again. And that's exactly what I did. I actually took this trade for the podcast because I thought, this is a good teaching moment of getting out, but um, doesn't mean you can't get back in the trade, right? So that's actually why I took the trade for the podcast Thursday, because I thought it was a good teaching moment. And again, so I got in here 37.87, 83, and then Friday yesterday it moved up nicely, moved up strong. Actually, I hit two profit targets into this strength. It came off a little bit, but again, going forward, I'm staying in this trade. Haven't got to trailing stop level yet, but I'm staying in this trade until we close under this 200. So as long as it's above this 200, I'm in. The closes below, I'm out. So the remaining shares that I have on this particular trade up 2.5%. But a good example of seeing one entry getting stopped out, but showing you that you can get back in if it closes back above the key level, which it did on Thursday. So the remaining shares up here up 2.5%. And then VIX. I entered a new trade on VIX on Friday. So I've been talking about entering VIX for several weeks. I have this order block. I mean, if we go back to this order block, that's a good example, a good illustration. Here's your order block. Swing low, swing high, lower swing low, market structure change. If we look up here when VIX was almost $40 and we look back to the order block, was smart money buying here? Well, in hindsight, clearly they were buying here. Well, we're back to the smart money area. Does it mean it's going to hold this time? Not necessarily. But in my experience, after you've had a huge run up and then for some reason you come all the way back to the smart money area, it's smart money more times than it's not, but it does this particular time doesn't have to be. So I took the trade here on Friday. Why? Two reasons. We rejected the high of the order block. And I've mentioned for the last few weeks, if VIX comes down into this order block and rejects the high or the low of the order block, very likely I will take the trade. Well, that happened Friday. So I entered here at 28.20 because it rejected the high of the order block. During the day we were in it, we closed back above it. That's rejection high of the order block. In addition to that, we also had a V1. Here's bar 1, here's bar 2. 2 goes under bar 1's low, closes above bar 1's close, adds bonus points to the trade. So I position size, I place my emergency stop 2 ATRs below as always. Now the key is, where's my stop? My stop is simply a close below the low of this order block. The low of this order block is 27.41. So as long as it closes above 27.41, I will stay in the trade. If it moves up on Monday, I will take partial profits into the strength. If I get to trailing stop level, then I go into trailing stop level, right? So I know exactly what I'm going to do. I know my worst case scenario, which is a 1% loss in the account. It's unlikely that that's going to happen, only about a 5% of the time. That will happen. The other 95% of the time, if I have a loss on the trade, it will be because it closes below the low of the order block. But this is a perfect entry, and the key is being patient, waiting for it. Doesn't mean it's going to work out, but I have the structure to where if I'm wrong, I'm most likely wrong small. If I'm right, who knows? Maybe have a big rally back up. We don't know, but we have to put ourselves in the best position to start. And so this particular trade, I entered just a touch early. This particular trade's up 0.74%. All right, so those are the open trades. I also did have one trade that I had to get out of, which was Johnson and Johnson. I entered Johnson and Johnson on the 24th of April at 227.50. Why? Simply because it rejected the 100-day moving average inside the order block. And then the very next day, close below, I'm out. A lot of my trades will do that. I'm in one day, I'm out the very next day. And for professional traders, you will see this very, very often. because you want to be very impatient with your losers and you want to be very patient with your winners. So I have many trades where I'm in one day, out the next day. But if I'm in a trade for 7 days, 20 days, 30 days, I guarantee you that trade is a winning trade because I would never stay in a trade that long if I was underwater on the trade. So this particular trade, I can't, let's see. Yeah, down 0.84%. Okay, so those are all the open trades and the closed trades. Really, a lot of the trades didn't do much, of course, other than AMD. I got rid of a lot of trades in the last couple weeks, really good ones, good examples for teaching, but now they're gone. So the rest of the current open positions right now are just kind of not doing much. So that's how it goes sometimes. So before we get into the trades for next week, let's first talk a little bit about trader psychology. Spend a few minutes on that. I always think it's helpful. All right, so this week's trading psychology post, this was posted by Julian Komar. He has a really good channel on X. You can follow him at blog Julian Komar. Has great content always. Whenever I see something from him, I always read it. And he is I believe this is for Mark Minervini. Of course, you know Mark, Market Wizard. He's sharing this. So, a few key decisions early in my trading career and my financial life completely changed for the better in just a few years. All right. Well, that made a big change in his life. Let's see what he did. Number one, no big losses. It's the biggest killer in trading is having big losses. So, how do I adjust for that? I have an emergency stop. That's my maximum allowed loss. That's if it all hits the fan, that's how much I'm going to lose. And again, it doesn't happen very often, only 5% of the time. But I account for that, I adjust for that, and I structure the trade so that I do not have any big losses. Number two, no averaging down. A lot of people do this. They average down. You know the saying, losers average losers. I do not average down. I enter the trade. I have my structure. That's all there is to it. So number one, no big losses. Number two, no averaging down. Number three, no chasing extended stocks. A lot of people have a problem with this, especially beginners, especially retail traders. They chase extended stocks. You know, the way that I trade, I have certain levels that I would never buy if it's over a certain level. And I see this all the time. People like to buy extended stocks because the news is good. Every time they turn on the TV or the internet, there's good stories about it. Well, when that happens, that's usually closer to the top than it is the bottom. So no chasing extended stocks. You have to have levels on your charts where you know I'm not buying there. I don't care how good it looks or how good the news is. If it's above this level, it's a no-go zone. Number four, no giving back decent profits. A lot of times we have nice profits in our trades, give them back. Well, that is why I go into trailing stop mode. And if I have a close below a previous bar's low after reaching trailing stop mode, I exit half, right? And I have tight stop, and that has the effect of of moving all of your stops up. So you have to have trailing stops so that you do not give back the profits. And number five, always get odds on my money. How do you do this? You do this by having a good starting risk to reward ratio, like the AMD trade. If I was wrong, I was going to be wrong small. If I'm right, I could have a big outsized gain, which is exactly what I did. So when people talk about getting odds on your money, what it means is that you're entering a spot where the odds the odds of entering that trade are higher that it's going to go up, and that if it does go up, you're going to make more money than if you lose. So there's less of an odds it's going to go down, but if it goes down, you're going to lose less. And if the odds are higher, then it's going to go up. And if it goes up, you're going to make more money than what you were risking. So getting odds on your money just means entering at a key location, key support, key entry signal. And if you're wrong, being wrong small. And if you're right, having the ability for a large outsized gain. So thank you very much one more time. A few key decisions early in my trading career and my financial life completely changed for the better in just a few years. Number one, no big losses. Number two, no averaging down. Number three, no chasing extended stocks. Number four, no giving back decent profits. And number five, always get odds on my money. All right. Okay, let's look at the potential trades for next week. And so I always mention this during this portion of the podcast that here I have 10 potential signals for next week. Is it possible that all 10 of these could trigger next week? Yeah, 100%. They could all happen on Monday. Does that mean I would take 10 positions? 100% no. I only take one position per day. I only take the best position. Even if 10 of them signal as legitimate signals on Monday, I'm going to have to narrow it down to the best trade of the day. And I do this by giving a quality score to each setup. For example, if you have a rejection of a 200-day moving average and that's all, I give it a point. But maybe the second setup has a rejection of the 200-day moving average and a V1. That gets 2 points. Which one do you think I'm going to take? I'm going to take the one with the best report card, right? Now, there are times where maybe you have 4 entry signals, has a quality score of 4, but maybe the risk to reward is not good. So I have to take points away from that. So, it's a process of experience and looking at multiple signals and giving it values. I also look at the uh, longer term charts to get an idea. If I'm trading the dailies, possibly I look to the weeklies and see if I can see some kind of signal on the weeklies or rejection of levels on the weeklies that help um, support my case on the dailies. I also look at relative strength of a stock. That just means if the stock market's down, but this particular stock is up on a down day, that gets bonus points. So this is how I narrow down what I'm going to enter. And this is what I teach my students to do as well. And if I could just put in a little plug, I love to teach. I teach people all over the world, all different countries. I have taught for many, many years. And I teach a really great course. I think it's really great. It's a 20-hour course. It's a one-on-one course. So you and I will be spending 20 hours together, 2 hours a week for 10 weeks. I will teach you all the different setups that I use, all the different strategies. We'll go through everything. Little by little, you will learn exactly how I trade, and you will have a skill that you can use for the rest of your life. I have turned out some really good traders. I really have, all the way from absolute beginners all the way up to the hedge fund level. So if you're interested in doing my 20-hour one-on-one course with me, like I said, it's 2 hours a week for 10 weeks. My email is in the link of this YouTube video. Just send me an email and we can get the conversation started. I'd love to have you as a student. I'll teach you everything that I know, and the course does cost $2,000, but I promise you it's worth every single penny. If you like online courses, I also have a really good online course available at udemy.com. It's the Deep Dip Buy Stock Trading Strategy. It's very affordable. It's between $30 and $50. 9.5 hours of video. I remember that took me 6 months to create that course, but that is a really, really good course and it's very affordable. Okay, something happened to my, are we still going? Yeah, we're still going. So anyway, the Udemy course, the link to that is in the description of this YouTube video as well. So, all right, let's get on to the potential trades for this particular week and see what we have going. So first up is Berkshire Hathaway. All right, so we have an order block on Berkshire from the past. If we look in the past here, this order block was created on the August 4th of 2025. We move that order block into the future. And look, we are coming into that smart money area. Now, we're not there yet. And there are no moving average inside this order block. I can't take a rejection of the high of the order block because it's too much of a risk to a close to the bottom of the order block. So what I'm looking for, if Berkshire continues to move back down, I'm looking for possibly a deep dip buy of an under 30, over 30 on the RSI inside the order block. We also have this this megaphone trend line. A megaphone trend line is when you take a swing low and you have another swing low and you connect those swing lows out into the future. Generally, that third point, you will have some type of bounce there. Doesn't mean you have to. So going forward on Berkshire, if next week we reject this trend line one way or the other, we go underneath it, close back above it, or intraday, I would certainly consider taking the entry there. Or if we go under 30 RSI and then close over the 30 RSI inside this order block, I would also consider taking that there. So this is a very tall order block, no moving averages. So again, looking for rejection of the trend line or looking for rejection of the 30 RSI. GDX is the gold miners ETF. Lots of different interesting things going on here with GDX. We have an order block from the past here in the blue. We have another order block, a lower order block from the past in the green. We have an island reversal here in the orange. You see we gapped down, we had sideways movement, then we gapped up, creating this island reversal. Remember, if we have an island reversal, the high of the island reversal is an interesting level. Here it is, right here, 85.10. So next week, if we reject this 85.10 level, we reject the high of the island reversal, I would consider taking it there. Also, I would consider a rejection of the 200-day moving average here, which is 82.17, because it's so close to the top of this blue order block. If we continue lower, this 250-day moving average, the purple line inside this lower order block, would be key. So the three levels that I'm looking for: rejection of the 250, which at the moment is 75.94 in this lower order block, rejection of the 200 to 82.17, or a rejection of 85.10, which is again the high of the island reversal back here in March. So a lot of different support levels coming in here, a lot of different options. I'll just have to see what happens. Home Depot. All right, well, we have an order block, a recent order block. Why? Swing low, swing high, lower swing low, market structure change, defines the order block. Here's the order block. The key level that I'm looking at right now is this 319.40 level inside the order block. So why did I put this line in myself? I put this line in because back here, these three bars create a V2. Bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. When that happens, I know that the key support level is halfway of the washout bar. This number 2 bar is the washout bar. That's 319.40. So that's why I moved this into the future. There's no moving averages here. So I created my own because I know halfway of a V2, there'll be some inherent support. 3 days ago, look exactly where we came down to, and that's where it bounced. It was exactly that level. Now, I didn't take this trade, moved up from there, moved down on Friday. So I'm looking for two things on Home Depot, either a rejection of 319.40 or a rejection of the bottom of the order block at 315.31. Johnson & Johnson, we discussed this trade. I got in, took a loss on this trade, got in here with the rejection of the 100-day moving average and then out the very next day when we closed back below. But I am looking forward to potentially, I just talked about megaphone trend lines. Here's a megaphone trend line, swing low, lower swing low. We connect that moving out into the future. And if we are above that trend line at the moment as support, but if we come back down further, a rejection of that trend line, about 225.32 inside the bullish order block, would make a lot of sense. So that's what I'm looking for. is another test and rejection of this long-term trend line on Johnson & Johnson. Nike recently had a structure change, swing low, swing high, lower swing low, market structure change. As soon as the market structure changed, it defined the order block, lowest closing bar prior to order block. The high and the low of that bring it into the future. Now, could I have taken this trade on Thursday with rejection of the high of the order block? Yeah, of course I didn't because the order block's kind of tall. So what I'm looking for right now is a rejection of $43. Why $43? Because on this particular day, we had an abandoned baby. We gapped down the previous day and then we gapped up. Not a lot, but we did gap up. And so the high of that baby, so this becomes the baby here, the high of that baby is the support. So that's what I'm looking for. I'm looking for a rejection of $43. If that happens, 2 ATR stop, 4 ATR profit target. Pfizer. Okay, so Pfizer is coming into some interesting levels here. We do have earnings coming up, so I'm not going to take this trade prior to earnings, but after earnings, depending on what happens with earnings, if it heads down, there are two key levels that I'm looking at. The first key level, you can see we have the order block. The first key level is this 2566. So why did I put this here? Same thing. Back here, we have a V2, bar 1, bar 2, bar 3. Halfway of that bar 2 is going to be the inherent support. So I'm looking for, after earnings, of course, I'm going to look for a rejection of 2566, or if it heads lower, really nice area would be the 200-day moving average at the bottom of the order block. That would be my preference, and that's at 2524. RBLX, okay, well, we had earnings here. It really crashed down. Yeah, tough. But I looked at this a little more carefully, and I had to go back many years to find this order block on RBLX. It's a thin little order block, but it's really quite interesting that an order block that happened years ago, look where the buyers came in on Friday, right at the top of that order block. Again, this is an order block from years ago, and that's where the support was. So it's interesting how strong these order blocks can be. Now, I didn't buy this on Friday because it bounced up pretty high. There's no good risk to reward ratio here. However, if we do come back and reject the high of this order block at 41.88, I would consider buying there. My stop would be closed below the low of the order block, and the low of the order block is 39.84. So I'm looking for a rejection of the high of the order block or a low of the order block. Maybe this just continues up, and for RBX shareholders, I hope it does. But if it does come back and retest that, the high of the order block, I would consider taking it. My stop would be a close below the low of the order block, or a rejection of the low of the order block would be another entry signal, of course, with a close below the order block as my stop. Bonds, I considered buying bonds on Friday. Why? Because we rejected the bottom in this order block. But a little while ago, I was telling you about if you have two entry signals that I'm only going to take one. Well, my two candidates for the day were TLT and VIX. TLT because it's valid. It rejected the bottom of the order block. But I took VIX instead of TLT. Why? Because it rejected the high of the order block and it had a V1, had a higher quality score. So that's why I passed on TLT and bought VIX. Makes sense? But that being said, I still would like to potentially enter TLT because it's down in this key area. And if you go back in time, you can see this area, this order block was back here from 902.25. This is a key area. We got down here, bounce. Now we are there again. Doesn't mean it has to bounce from here. It just means that it's in a key area. And if I'm wrong, I can be wrong small. And if I'm right, I could have the potential for an upside gain. So I'll just have to see what TLT does on on Monday. Maybe we get another rejection at the bottom of the order block. Maybe we close up higher and we create a V2, right? We haven't created a V2 yet, but if we create a V2, then it's a V2 inside the order block. That's good. That's valid. And again, if you want to learn more about V1s, V2s, just go to my YouTube channel, and I have a video there that explains those in detail. USO, which is oil. Well, we have a nice potential entry point. It's a long ways away. I don't know if we'll get there, but look, we have a swing low, we have a swing high, we have a lower swing low. We break market structure to the upside, defines the order block. I take the high and low of the order block, move it into the future. Look at that 50-day moving average, the gray line, just right there, 116.78. It's very unlikely we're going to go there. But I like to have these things marked up so that if for some reason next week it gets there, I'm like, oh, hey, it got to my order block and got to my signal. So like I said, it's very unlikely that it's going to get there. But if it does, I would be looking for a rejection of the 50-day moving average inside the order block, 116.78. And last but not least is XLV. Okay, XLV, you see 3 days ago we closed below the low of the order block, and then we ripped really much higher. Could I have entered here? I could, but the risk to reward is really bad. I mean, it did close above the 300, it closed above the 250, but the risk to reward is not good. So I am looking for three key levels, I should say. Here we have a 250-day moving average at 144.35. We have a 300-day moving average at 144.06, and we have the top of a baby. See the baby? Gap down, gap up. The high of the baby, 143.28. Now, Thursday, we had the big move up here on pretty decent high volume. That shows me there's some buyers coming in. Now, we were down on Friday on really small volume. So to me, that doesn't really concern me. I think that's just some profit taking from this big move up. But to make things simple, what I'm looking for is I'm looking for a rejection next week of the 250 at 143.35. Another option would be a lower rejection of the 300-day moving average at 144.06, or a rejection of the high of the baby of 143.28. So that's what I have for next week, everybody. I hope you found today's podcast helpful. If you have any questions, please let me know. I'll do my best to get back to you. Like I said, love to become your teacher, love to teach my 20-hour course and have you be my student. I will teach you everything I know. I'll give it 110%, and I promise you're going to learn a lot. So just reach out to me. And I also do consulting. I've consulted with hedge funds and other things. So, if there's other things in addition to the actual course, if you have with trading, I can help you. Just reach out to me any way I can. I can help you. I consult with a lot of people on many different things. So if you need some help with that, please let me know. But thank you for being here, everybody. I always like to leave off with, just if you can, try to go out and do something nice for another person each day if you have the opportunity. It's just, in this world, it would just be a great thing if everybody would do one nice thing for another human being. It would just make the world a better place. And I think this world needs it. I'm a big animal lover, so if you have the opportunity to do an act of kindness for an animal that comes across your path, do it. They appreciate it just like we do. But anyway, I hope you enjoyed today's podcast, everybody. I have a baseball game to get ready for, so go out there. Last week I struck out, so hopefully maybe I can get a hit this week. So looking forward to that. But thanks a lot, everybody. Enjoy the rest of your weekend, and God willing, I will see you next week. Take care.
U.S. government requires disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.